natural gas futures surged sharply on Monday, driven by a combination of a sudden shift in weather fundamentals and an aggressive technical response following a bullish gap higher on the daily chart. A powerful cold front sweeping across major U.S. demand centers, with freezing temperatures reaching as far south as lower Florida, triggered an unexpected spike in heating demand and forced a rapid repricing of near-term risk. From a fundamental standpoint, traders were already aware that colder weather was approaching, with weather analysts calling for high demand from Sunday through Wednesday. However, conditions intensified after January 15, when the National Weather Service issued winter storm warnings highlighting hazardous wind chills and snow threats from the Midwest through the East Coast. While this event does not qualify as a classic polar vortex, the scale and reach of the cold proved sufficient to pressure short positions and draw in fresh speculative buying. Professional traders typically focus less on immediate weather events and more on the 10 to 15-day outlook. In that context, sentiment shifted decisively as forecast models turned colder for late January. Current projections for January 26 through February 1 point to a potential Arctic intrusion, with Arctic air spreading across much of the eastern United States. This scenario raises the probability of stronger heating demand and larger storage withdrawals than previously anticipated. That said, longer-term fundamentals continue to temper the bullish outlook. Storage inventories remain well above the 5-year average, providing a meaningful buffer against short-term demand shocks. This surplus limits the market's ability to sustain extended upside moves unless cold weather persists or intensifies beyond current expectations. As a result, while volatility is likely to remain elevated, price gains may be capped unless forecasts beyond early February continue to trend colder. Historically, brief cold shots tend to spark short-covering rallies that fade within days. In contrast, forecasts signaling prolonged cold or renewed polar vortex risks have the potential to generate rallies of greater magnitude and duration. From a technical perspective, the rally was reinforced by strong chart signals. Key support is now defined at last week's low of $3.10, which also sits comfortably above the psychologically important $3 level. The market quickly cleared a minor 50% retracement at $3.35 on the open and is now challenging resistance near $3.60, just below the recent swing high at $3.63. A decisive break above that level would confirm a broader upside breakout. If momentum continues, the next major upside targets are the 50-day moving average at $3.85. Beyond that, the $4 level comes into view, although reaching that level would likely require a stronger and more persistent cold pattern to overcome longer-term bearish pressures embedded in the broader trend. Don't forget to drop a comment, hit that like button, and support the channel to help keep this channel going. See you in the next one.